investments.
Welcome back to our deep dive into intercorporate investments.
I'm still thinking about all the things we learned in part one.
Yeah, a lot.
From IFRS 9 to the equity method and the acquisition method, it feels like we're finally starting to understand the language of corporate investments.
We've definitely covered the basics, but as promised, in this part, we're going deeper.
Deeper, right?
We're going to tackle some of those trickier accounting concepts,
Okay.
like the amortization of excess purchase price, the fair value option, and the consolidation of VIEs and SPEs.
My brain is ready for more. Let's start with the amortization of excess purchase price.
All right.
What is that exactly?
Remember how we talked about how the price a company pays for an investment can be more than the book value of the shares they're buying?
I remember.
Well, that difference, that excess, needs to be allocated, and sometimes it needs to be amortized over time.
So it's not just a one-time adjustment.
Nope. It affects the financials over multiple periods.
Okay, so how does it work?
Well, first, we allocate the excess purchase price to specific assets
Okay.
based on the differences in fair value. For example, if the fair value of the acquired company's buildings and equipment is higher than their book value, a portion of that excess purchase price would be allocated to those assets.
So we're basically adjusting the value of those assets to reflect what they're really worth.
Exactly. We're making sure the price tag matches the actual value.
I like that analogy.
And for assets that are depreciated or amortized over time,
Like buildings and patents.
right, the portion of the excess purchase price that's allocated to those assets is also amortized.
Okay, so we're spreading the impact of that excess purchase price over the time those assets are expected to generate economic benefits?
You got it. It's all about matching the expense with the revenue.
That makes sense. But what about the portion of the excess purchase price that can't be allocated to specific assets? What happens to that?
That's where goodwill comes in.
Goodwill, of course. So any leftover amount goes to goodwill.
Exactly. And remember, goodwill isn't amortized, it's tested for impairment each year.
Right, we talked about that in part one. So the excess purchase price is split between specific assets that are amortized and goodwill, which is tested for impairment.
Got it. Now, I'm curious about this fair value option.
Okay, what about it?
What is it exactly?
The fair value option basically gives companies the choice to measure certain financial assets and liabilities at fair value,
Okay.
even if the accounting rules would normally tell them to use a different method.
So they can choose to mark to market certain items on their balance sheet, even if the rules don't require it.
Exactly. And both IFRS and US GAAP allow this for equity method investments.
But there are some restrictions. There are. Under US GAAP, any company can use it. But under IFRS, it's mainly restricted to venture capital organizations, mutual funds, and similar entities.
So IFRS is a bit more cautious with the fair value option for equity method investments.
That's right.
Now, if a company decides to use the fair value option,
They have to make that choice when they first recognize the investment, and they can't change their mind later.
it's a big decision.
It is. It's a strategic decision with long-term implications.
Right. They need to weigh the pros and cons carefully.
Absolutely.
So after that initial choice, the investment is reported at fair value each reporting period, with any gains or losses going through their profit or loss.
That's how it works.
Okay, so it's a more dynamic approach
Yeah.
compared to the equity method, where the investment's value is only adjusted based on the investee's profits or losses.
It is. It gives you a real-time view of the changes in value.
But that also means more volatility.
Exactly. It's a trade-off between accuracy and stability.
All right, let's switch gears now and dive into the consolidation process for VIEs and SPEs. Remember those structures we talked about in part one? The ones that could be a bit tricky to understand.
I do.
Well, now we're going to figure out how they're reflected on a company's financial statements.
Sounds good.
We talked about how these entities are often used for specific purposes, like securitizing assets or leasing property.
Right.
But the tough part is figuring out when a company has enough control over a VIE or SPE to justify consolidating it.
That's right. It's not always clear-cut.
I'm already feeling a bit lost.
Yeah.
Can you walk us through the criteria for consolidation?
Sure. Under US GAAP, we look at whether the VIE has enough equity at risk to finance its activities without help from others,
Okay.
or if its equity investors can make decisions, absorb losses, or receive returns.
So we're looking at who's really in control.
Exactly. And if the entity that benefits the most from the VIE, usually the sponsor, doesn't meet those criteria,
Then they have to consolidate it as a subsidiary.
they do, regardless of how much equity they actually hold.
So it's not about ownership. It's about who's calling the shots and who's benefiting.
Precisely. IFRS focuses on whether the company can direct the VIE's activities and if they're exposed to variable returns.
Okay, so both IFRS and US GAAP focus on control, not just ownership, when it comes to consolidation.
That's right. But how does this actually work?
Yeah, how do you consolidate a VIE or SPE?
Well, we combine the VIE's assets, liabilities, revenues, and expenses with the parent companies.
Okay.
But we have to eliminate any transactions between the parent company and the VIE
Why do we do that?
to avoid double counting. We don't want to count the same thing twice.
Right, that makes sense. So we're basically pretending that the VIE is just an extension of the parent company,
Exactly.
even though it's a separate legal entity. We're looking at the economic reality.
Precisely. And this can have a big impact on the parent company's financials, especially if the VIE is large or generates a lot of revenue and expenses.
So it's definitely something analysts need to pay attention to. But why do companies even bother with VIEs and SPEs? What's the point?
Well, there are a few reasons. They might use a VIE to isolate certain assets or liabilities. Okay.
Which can reduce their risk or make them look better to lenders.
So it's a way to make the parent company look more financially attractive.
That's one way to look at it.
Yeah.
But it can also be used to hide things from investors.
Really?
Yes, in the past, companies have used VIEs and SPEs to keep debt off their balance sheets. Or to do things that wouldn't be allowed under normal accounting rules.
Yeah.
So it's important for analysts to be skeptical.
Definitely. We need to look beyond the surface and make sure we understand what's really going on.
Exactly. Now, let's talk about disclosures.
Okay.
What kind of information should analysts be looking for when it comes to VIEs and SPEs?
That's a good question. What are the red flags?
Companies need to be transparent about their involvement with VIEs and SPEs.
Okay.
They need to disclose the risks and rewards and any judgments they made in the consolidation process.
So they have to explain what they're doing and why.
Exactly. Analysts should pay close attention to these disclosures because they can reveal things that you might not see in the financial statements. So we need to read between the lines.
You got it. Now, let's shift gears again and talk about transactions between the investor and the investee.
Right.
These transactions can really mess up the consolidated financial statements if they're not handled correctly.
How so?
Imagine Company A sells goods to its subsidiary, Company B, at a markup.
Okay.
If we just consolidate the financials without any adjustments, we're counting that profit twice, once for Company A and again for Company B.
So it's like inflating the revenue and profit.
Exactly. We have to eliminate those intercompany transactions to get an accurate picture.
Okay, so we scrub out those internal transactions to prevent any artificial inflation.
Exactly. We want to see the real economic substance.
But how do we actually do that? Are there rules for different types of transactions?
Yes, there are. For example, if there's an intercompany sale of inventory, we have to eliminate the sale and the cost of goods sold from the income statement
Okay.
and adjust the inventory balance on the balance sheet to reflect the original cost.
So we're basically pretending that the intercompany sale never happened.
Precisely.
And we're showing the true cost and revenue from an external perspective.
You got it.
This elimination process seems pretty technical.
It is.
I'm guessing there are specific rules we need to follow.
Yes, both IFRS and US GAAP have detailed guidelines on how to handle these intercompany transactions.
Okay, so we need to be mindful of these transactions and make sure they're properly eliminated to avoid distorting the consolidated financials.
Absolutely. But even with these adjustments, there can still be comparability issues when analyzing companies that use different accounting standards.
Right, those pesky comparability issues pop up again.
They do. Even though IFRS and US GAAP are pretty similar when it comes to intercorporate investments, there are still some key differences.
So we can't just assume that the numbers are directly comparable.
We can't. For example, IFRS and US GAAP have different ways of measuring goodwill and non-controlling interest.
Okay.
And these differences can affect key financial ratios, making it tough to compare companies.
So it's like comparing apples and oranges.
Exactly. Analysts need to be aware of these comparability issues and adjust for them when comparing companies that use different standards.
It sounds like you need a lot of expertise to navigate these complexities.
It does take some experience and judgment.
This has been a lot to take in.
We've covered a lot of ground in this part.
From excess purchase price amortization to consolidating VIEs and SPEs and eliminating intercompany transactions, we've really gone deep into these investments.
We have.
But we're not done yet, are we?
Not quite. In Part 3, we'll look at some other issues that can make it hard to compare IFRS and US GAAP.
Okay, like what?
Things like contingent assets and liabilities, contingent consideration, in-process R&D, and restructuring costs. These are all areas where small differences in accounting treatment can have a big impact on the reported financials.
Sounds like we're in for another round of learning.
We are.
But that's what the deep dive is all about, right?
That's right. We're here to unpack those complex topics and give our listeners the knowledge they need to make smart decisions.
And for our CFA Level 2 candidates out there, this stuff is pure gold.
It is. So grab your notes, highlight those key takeaways, and get ready for the final part of our deep dive.
We'll be back with more insights to help you ace that exam and confidently navigate the world of finance.